Hello, this is Bob Steele. In this lecture, we will talk about Chapter 8, Internal Controls. We're going to start off with defining the internal controls. What are they and why do we need them? What is their purpose? So first off, the purpose of the implementation of internal controls will be to protect assets. The purpose of internal controls could be to ensure reliable accounting. The purpose of internal controls could be to urge adherence to company policies. And the purpose to internal controls could be to promote efficient operations. So we're going to then talk about a law that relates to internal controls for publicly traded companies being Sarbanes-Oxley. Note that internal controls was not generated out of solely the need for regulation. It is something that is generated within accounting in order to help safeguard our assets from just a business perspective. But from a publicly traded perspective, we in the public, because these stocks are being traded publicly and we rely on the information, we have this added need for more confidence. And this Sarbanes-Oxley Act came in the wake of some fraud scandals such as Enron in an attempt to provide more security for information that's being provided to the public on publicly traded companies so that better decisions can be made in terms of investing. The Sarbanes-Oxley Act requires managers and auditors of public companies to document and certify the system of internal controls. Section 404 of Sarbanes-Oxley requires that managers document and assess the effectiveness of all internal control processes that can impact financial reporting. So, although the U.S. companies have had scandals in the past, the U.S. companies are usually very reliable in comparison to many other places in the world, and that is worth a lot. So that's the reason that many people invest in U.S. companies. Isn't necessarily because there's a lot of growth potential, because we're already at the peak of the growth potential. Our companies are more likely, the large companies, to stay relatively flat with modest growth, as opposed to the emerging markets, which could have potential for very large growth. But we have trust in our financial statements in part because of regulations like that, and that then leads to confidence, and that confidence leads to people wanting to invest more. So any business transaction, if we can increase the level of confidence, then that increases the level of trade. And something like a Sarbanes-Oxley, in order to help give accurate information on the financial statements, is the idea of this, will then help us to generate more money, build more confidence in the system, and that confidence is very needed in order for us to grow, because that's the way trust is needed for transactions to happen. Now, on the other side of things, note that Sarbanes-Oxley is another regulation, a big regulation, which includes added auditing regulations and rules for reporting, and therefore it does cost a lot of money as well. So notice there's always a debate, there's always a trade-off. Is the Sarbanes-Oxley providing the confidence level that is drawing in enough added revenue and safeguarding us in such a way that it is worth the added cost that is being put into the system, into our economy? And so that's always the cost-benefit analysis we're going to have. No question that the idea of more secure information, more reliable financial statements is a valued goal. And the question is, how can we do that most efficiently? And that's a continued debate that proceeds with laws such as Sarbanes-Oxley. Principles of internal controls principles common to all companies. We want to establish responsibility. So we want clearly defined who's responsible for what. We want to maintain adequate records, be able to retrieve these records. We want to ensure assets and bond key employees. We want to make sure the assets are insured and safeguarded. Separate record keeping from custody of assets. This separation is one of the key components of internal controls, meaning the person that records the asset shouldn't be the one that has custody over the asset, because if you give the same individual those two items, then they can more easily falsify the recording and falsify the holdings of the asset. If you separate these two activities into two people, they would then have to come together and collude in order to commit a fraud. So divide responsibility for related transactions, same idea. Anytime there's a potential for some type of fraudulent act, what we want to do is try to break up the responsibilities in such a way that it would take 2 or more people in order to commit the fraud that would have to come together and do it, rather than it all being in one individual. Apply technical controls, technological controls. So now we're going to use database programs and things like this, which have the opportunity for us to separate the controls and separate who can get what and access what parts of the database program, and perform regular and independent reviews. Note that internal controls, we could have the best internal controls out there and we implement these and no one follows them, right? If that happened, because internal controls does take more processing a lot of times, is basically bureaucracy a lot of times, more red tape. If we come up with the rules and they are not being followed, then of course they don't have any effect. We got to review the process, make sure they're being implemented and are effective. So technology and internal controls. So technology can actually reduce processing error time. So because stuff is not done by hand and we're putting it into a database program or some kind of program such as this, there's less chance for errors that are going to be made from the processing. Limited evidence of processing. A common criticism of internal controls is there's less of a paper trail on the computer's internal controls, but there are technological ways that we can come up with more of this evidence, meaning database programs can show who's been logged in, when they logged in, who did the transaction. So slowly we're replacing the database, well, pretty quickly actually, we're replacing this paper trail with a digital paper trail that can be tracked fairly readily. For example, even in systems such as Moodle rooms that are used in the schooling, we can see who logged in, we can see when they logged in, how long they were there, and these types of data that can be really helpful in tracking. E-commerce has obviously increased immensely for selling and purchasing over the internet. More extensive testing of records. The idea of a computer is that because it's so quick, we can test a lot more data more readily. So in the past, if we wanted to test or audit something, we might have to go pull the file out, which of course would take more time. Because things can be done so quickly, we can actually test more data in a computer system. Crucial separation of duties. Once again, the database program could be set up in such a way that certain people can only access certain pieces of the database program, and that is key towards internal controls, because one of the key controls, probably the key control, is the separation of duties. So someone who's in charge of recording the payroll is not going to have access to other areas of the business, and we can separate that access with the use of passwords and different access to certain database programs. So limitations on internal controls. Now, note that internal controls are not perfect. Sarbanes-Oxley does not eliminate the possibility of fraud or error. What it does is try to lessen the risk of a potential fraud or error happening. So limitations, of course, are going to be in terms of human error. We have negligence, fatigue, misjudgment, confusion. These things are just happen. They're going to happen. If they do, they're not as concerning as a potential fraud over here. And whenever you think of fraud, of course, fraud means intent. There was an intent to defeat internal controls for personal gain. So note that the result could be the same. It could be a loss of something. But when you put in this intent there, that really makes a big difference in terms of what is fraud and what is error. If there's intent to defraud, then we have a problem in terms of the internal controls and the atmosphere of the company that could be much more hazardous going forward because of that culture in the company that would allow that. Now, when would this be most readable or most dangerous? Human fraud, triple threat. If there's opportunity, there's pressure, and there's rationalization. So that's why we have separation of duties. If we had the same person collecting cash and recording cash and also doing the bank reconciliations, it's so easy. I mean, they're so easy for them to commit fraud in that case. And if you couple that with pressures, say someone is having health issues and financial problems, and you couple those two things, and you have the rationalization, meaning something, whenever we commit an act or whenever we do something, we tend to rationalize it in such a way to say it's not a big deal. And that rationalization often takes the place of, this is only going to happen one time, and then it happens more often and we rationalize it. Or Oftentimes in a large company, the rationalization could be something like, this is a big cold company and I'm just one individual and this amount is immaterial to the company, and that type of rationalization. Now notice the smaller frauds are things that if we catch it, we can fix it, we can basically fire the person who committed fraud. Not as big a deal. If the fraud is in management, however, then they can circumvent the internal controls just through the authority that they have, and that's where the real large potential problems are at in these larger companies.